Good evening, everyone. Speaking on behalf of Anand Rathi Wealth, I'm Lalit Jessing from Concept PR, your moderator for this virtual brokers and analyst meet. I would like to take this opportunity to thank you for taking out your time from your busy schedules to join us. We appreciate your presence and extend a very warm welcome to all of you. The objective of today's live session is to understand Anand Rathi Wealth's interest in raising finance, why an initial public offering, and what they do as a business organization. Under normal circumstance, this would have been an on-ground event, but we all are increasingly getting accustomed to this as a safer and more convenient format of attending and conducting the roadshow. We hope you gather the same or a better experience from the comfort of your home and office. Before I review the functionality of the webinar, I would like to bring to light that Anand Rathi Wealth commenced operations in 2002 and is an AMFI registered mutual fund distributor. Today, it's one of India's leading non-bank wealth solutions firm and facilitates investment in various financial instruments. It is ranked amongst one of the 3 largest non-bank mutual fund distributors across the country by gross commission earned for the last 3 fiscals and provides services primarily through its flagship private wealth vertical, where it manages rupees 30,209 crores in assets under management across 6,564 client families as on August 31st, 2021. Moving ahead, you'll be kept on mute throughout the event and all questions will be answered via the Q&A chat box only, where you can type your question in session or at the end of the webinar. Would request all participants to please limit yourselves to 3 questions only. If we miss answering any of your questions, don't worry. You can email us at ipoteam@conceptpr.com and we will try to be swift in responding back to you. Going forward, it's a great pleasure to introduce our speakers today. From the company, we have Mr. Anand Rathi, founder, chairman, Anand Rathi Group. Mr. Pradeep Gupta, co-founder and vice chairman, Anand Rathi Wealth Limited. Mr. Amit Rathi, director, Anand Rathi Wealth Limited. Mr. Rakesh Rawal, CEO, Anand Rathi Wealth Limited. Mr. Jugal Mantri, Group Chief Financial Officer, Anand Rathi Group. Mr. Firoz Aziz, Deputy CEO, Anand Rathi Wealth Limited. The representation from the book running lead managers are Mr. Venkat Raghavan, MD and Head ECM, Equirus Capital Private Limited. Mr. Sunil Willing, Managing Director, Head of Advisory Capital Markets, BNP Paribas. Mr. Samir Lotankar, Director, Advisory and Capital Markets, BNP Paribas. Mr. Vishal Bangar, Head ECM, IFL Securities Limited. And Mr. V. Prashant Rao, Director, Head ECM, Anand Rathi Advisors Limited. On behalf of the company and lead managers to the issue, let me thank all participants for being a part of this session. I now invite Mr. Sunil Willing from BNP to deliver the opening remark and commence this brokers and analysts meet. Over to you, Mr.
Great. Thank you. Thank you, Lalit. On behalf of the BRLM, it's my pleasure to welcome you to this broker and analyst meet. BRLMs to the issue are BNP Paribas, Equirus, IFL, and Anand Rathi Advisors. I think Lalit has introduced the management team and the company. So what we will talk about a bit is the transaction. The transaction is for 12 million shares for secondary offering. The anchor tranche opens tomorrow, and the main book is from 2nd to the 6th of December. The price range is rupees 530 to rupees 550 per share. And we'd be happy to answer any questions about the transaction as we proceed. With that, I'd like to welcome Amit Rathi to start the presentation.
Thank you, Mr. Willing, for the introduction to Anand Rathi Wealth Limited initial public offering and issues key highlights. I would now request the company team to take us through the organization's journey, struggles, and victories. Subsequently, take the attendees through the company's investor presentation to cover its business and financial details, as well as touch upon its key strategies going forward. Over to you, Mr. Rathi, to give the attendees an understanding of how the company has evolved as an organization and its key strategies. Rathiji, over to you.
Thank you, Lalit, and thanks, Sunit. Let me also join them in welcoming all my fellow brokers and analysts who are present in this meeting. I want to thank you for really very, very large presence, as I could see. Friends, you are aware that we started with the broking business way back into 1994. I, along with Mr. Pradeep Gupta, we started the broking operations and kept on expanding our different businesses and different verticals and segments every 2-3 years. And I'm glad to share with you that today we have more than 10 different verticals. Now, Anand Rathi Wealth Management is one of the most important vertical which we have. This company has grown very well in last 15-20 years, and I think I have an excellent team, led by Mr. Rakesh Rawal as CEO and Mr. Firoz as Deputy CEO. Amit obviously started the entire thing on way back in 2002, and today we have really, the team has not only developed a large number of relationship managers, but very good book, very good number of clients, as you will see from the presentation. So we today have, I think, one of the strong professional management in this company. Also, I think we are still, because we started broking, is still known as primarily a broking firm. But as you'll see, I think this business is a very, very large grown-up business now and contributes a lot in the overall performance. As you know, the wealth is growing. Wealth business is growing very much in India. The amount of wealth going up is tremendous, as Amit will point out in more details. I think there is a great potential of this business to grow much faster than any other business. And I think with these opening remarks, I would now invite Amit to make a presentation on our business. Over to you, Amit, please.
Thank you. Just getting the share. So thank you everyone for joining us today. I'll take you through a presentation which should last about 20-25 minutes and leave the floor open for more time for Q&A. The issue structure, Sunit has already touched on, but I'll just quickly highlight again. The price band is 530 to 550, 1.2 crore shares or 12 million shares, and the issue opens on 2nd December, which is day after tomorrow, and remains open on Thursday, Friday, and Monday, which is 6th December. Both BSE and NSE are the IPO venues. The employee reservation about 2.5 lakh shares. QIB will not be more than 50%. The non-institutional bidders not less than 15%, and the retail investors not less than 35% of the net offer. The core objective of the offering, of course, is to achieve the benefit of listing and the offer, and the sale of these 1.2 crore shares. From a lock-in perspective, all the pre-IPO equity shareholding will get locked in for a year, and the minimum promoter contribution will get locked in for 3 years from the date of allotment. We have all the BRLMs here as well, and the BRLMs on this deal are Equirus, BNP Paribas, IIFL, and Anand Rathi. So before I start, I think we'll just quickly introduce the board. In this company, we've got Mr. Anand Rathi, who's the chairman, Mr. Pradeep Gupta, myself, Amit Rathi, Rakesh, who's our CEO, and we've got a very strong independent director participation on the board as well, Mr. Mohan Pangsale, who is the former chairman, MD, CMD of Central Bank of India, Mr. Ramesh Chandak, who was former MD, CEO of KEC International, Mr. KG Somani, who's a renowned chartered accountant and the former president of Institute of Chartered Accountants, and Mrs. Sudha Navandar, who's again a senior practicing chartered accountant. So we've created a really strong independent board, and the business is run professionally. We have today with us Rakesh, who's our CEO. Rakesh joined us from Deutsche Bank in 2007, has spent a number of years there setting up their business in South India and Bangalore particularly, has spent almost 8-10 years with Hindustan Lever, ran his own business, so brings a lot of variety of experience to the business and the wisdom that this business needs. Feroz Aziz, Deputy CEO, is a more well-known face in the public media and brings a lot of dynamism and expertise around financial markets and products and structuring to the business. He's here with us as well. And Feroz has been with us since 2012. So our leadership team has been around for a really long time, and a very stable leadership team, not just at Rakesh and Feroz, but even the teams below them. So the way this presentation is broken up is essentially I'll touch upon 6 key areas. What's the market potential? What is the market segmentation that we're going after? What's our value proposition in that segment? The people and why they're important in this business. Of course, business performance, financial performance, and some of the new initiatives that we've been sort of focused on for the last few years. So market potential, everyone here, I think, knows this, and I don't want to spend too much time on it, but I think broadly what we're seeing is that the number of dollar millionaires in India are doubling every 5 years. That was what happened in the last 5 years and is expected in the next 5 years. The sort of whole financial share of assets within savings pool is rising. Within that, the share of investing vehicles like mutual funds is rising. So I think the macro opportunity is massive. The number of taxpayers who are declaring income of more than 1 crore is expected to go up 3x between FY18 and FY25. So I think the macro opportunity is not contested. I think all of us would probably agree that India is one of the best places today as far as the wealth management business is concerned. But I think within this also creates a situation where there's a lot of competition, because a lot of people see this macro story and want to attack this space. And I think the key differentiation that we hope to bring is, how do we sort of see this market and how are we playing this opportunity? So this is the way we sort of break up the market in terms of client segments. And I think the reason to do this is because each client segment has a certain different requirement. And therefore, the proposition needs to be tailored to deliver value to that client segment. So we've really defined this, as clients with more than 50 crores, which is the ultra high net worth space, the 5 to 50 crores, which is the HNI space. And that's the core focus for Anand Rathi's private wealth business. And then you've got the 50 lakhs to 5 crores. And if you see 51.5% of our business or current AUM actually comes from our focus segment, you see a 32% of the number from 50 lakhs to 5 crores. Most of these are new clients who've come in with smaller checks and hopefully will graduate on, up the pyramid as they mature in the relationship with Anand Rathi. We also have a fair chunk of clients who are in the ultra high net worth space. But I think the point to note here is that a lot of these clients, almost all these clients started with us below in the pyramid where they were smaller clients, but then had a liquidity event where they either sold a business or came into money and have stayed with us and become UHNIs within the system. But this is not a client segment that we go after, or we go after them from an acquisition process perspective. Now, the reason, of course, I'll just stay with that. The reason, of course, I think we've tightly focused on the segment is we believe that this is a segment that not only needs advice. I think all customer segments, be it a 500 crore customer, be it a 50 crore customer, 5 crore customer, or 5 lakh customer, everybody needs advice. But particularly this segment is a segment that 5 to 50 crore where they also believe they need advice and they're willing to pay for advice. And the cost of delivery, is viable through a human channel, through an RM channel, right? So this is a sweet spot. It's a more difficult business to build because client by client, our average client size today in the system is about 4.5 crores. So, right, it takes a while to build a big book as big as 30,000 crores that we've built cumulatively today. It's much more easier for potentially to go after 1,000 crore client, but the requirements are very different. The margins in their business are very different, and the competitive intensity in their business is different. So this is a space where clients want advice, are willing to pay for advice, and also are willing to sort of spend the time with you to build a relationship over a long period of time. These are not customers in our experience who are transactional in nature. They are very relationship-oriented customers. So what we've done is, moment we said this is our client segment, what is the solution that we build? Right? One of the things we realized, and this is something we realized over a journey of over 19 years that we've been in the business, that we can't be all things to all people. We really have to narrow down and saying who's our client and can we be really good at delivering one value proposition and not try and do 20 things for customers. And the customer segment that we focused on, we believe that 90% of this segment actually needs inflation plus return. And inflation, lifestyle inflation for most of these customers, they believe is 9-10%. So if one can deliver 12, 13, 14% long-term returns for these customers, they're very happy. with a standard deviation or risk that is lower than typically of paying 100% equity, creating liquidity, building a tax efficient portfolio, and creating an estate plan. So this is something that actually these customers really, if you can deliver this to customers, they're very, very happy with this. What we don't want, or we don't service, is customers who want 18, 20, 25%. That's a very different target segment, or customers who only want 5, 6%, where we can't justify a fee. So we've really narrowed down on this middle 90, 95% who actually want a steady long-term inflation plus return, and then built a very templated advisory and delivery process. So right from how client goals are set. So all our clients have 10-year goals. They are not interested in what will happen in the markets in the next 6 months, 1 year. Of course, they want to know, but the portfolio strategies are all designed over a 5, 10-year period. In fact, most clients have 10-year goals. There's a lot of time spent in coaching customers around, the investment process, risk in various asset classes, portfolio strategy, and there are certain model portfolios that are shared with customers where they can actually choose and decide which direction they want to go. And the core aspect of any wealth management business is not about recommendations, but it's about creating client conviction to act. Because there's no point giving advice if customers don't take that advice and act. And that's where we spend a lot of time in saying, how do we build, information, data, advice, and the communication of that advice in a manner which creates client conviction to act. And that's been one of the key parts of a success, or pillars of our success in this business. And then, of course, execution, reporting, ongoing monitoring. So, there's a standard template where every RM has to meet the client at least once a month. What is discussed in that meeting is also templated. All of this is very, very standardized. Now, what the standardization does is two things, and think of it like an FMCG business in some ways, where what we want to ensure is that whether a customer meets a RM in Chandigarh, in Pune, in Bombay, or in Bangalore, or in Calcutta, can they have a consistent client experience? Doesn't matter which RM they're meeting. Will they have the same experience? Will they get similar advice? Moment you can do that, then you can actually drive, far more scalable and sustainable business. Because the other thing this does for us is that we are no longer dependent on hiring RMs from the market laterally. Because one of the big challenges in the market is how do you get talented RMs that can actually, come in with all the knowledge to advise customers. Because we have standardized this process, we have actually moved to a model where we are now internally hiring fresh people, out of top business schools like IIMs or chartered accountants, making them account managers for a couple of years, where they train under RMs as apprentices, service their existing customers, and then go on to become independent RMs. That we've seen is actually a huge, the last 3 years, about 50 odd AMs or account managers have actually gone on to become RMs in the system. And which is a huge, huge plus, because that is what creates scalability in the system, because we're not restricted by the pool of RMs that is there in the marketplace. The other aspect which we really focus on, and I think is a big value add, there is no financial impact of this to us as a firm. This is the area of estate planning, where we work with clients in helping them make their wills, and also private family trusts. And our belief is that almost every customer, every individual should have, or every family should have the right, wills in place, the right process of setting up wills in place, nominations, etc. The need for private family trusts exists in almost every case as well. But this is not a service that most clients experience or are aware of. One of the things we did very early on in this business was we said, let's create this expertise internally and deliver it for free for customers. So if you see the numbers of, and we have shared here the number of wills and trusts that we create on an annual basis, it's a huge hygiene factor for the customer, but it also elevates our relationship with the client at a different level, because the moment a customer is ready to work with you on drafting his or her will or create a trust for the family, your relationship has gone to the next level with that client. And that is all what we're aspiring for as advisors, because that is what allows us to create a greater share of wallet and a more longer term relationship with the customer. The other key aspect of this business is really, and I spoke about the RMs, and how do you ensure that RMs really sort of succeed on this platform and stay on the platform? And like I will share data on the next slide, RMs really become successful and profitable for us after 3 years and 5 years. So there is a core, there's a big effort to ensure that RMs stay in the system. And from day one, we've really focused hard on building that culture. And a lot of credit here to Rakesh, who brought his huge experience at HUL and his own entrepreneurial days, and he was one of the most successful RMs at Deutsche Bank Pan India, where we said, let's create a true entrepreneurial culture. What are the pain points? Why do RMs leave? And we built out a ground up process where we said, for example, let's create an incentive plan or a variable policy plan, which is not variable in itself. Most companies have bonus formulas or incentive plans, but the formula itself keeps changing every year. So when we decided and set up this incentive policy in 2008, that incentive policy has remained consistent for the last 13, 14 years. It's not changed. There's a huge credibility with RMs when they walked in and partnered with a platform. And this is what Anand Rathi Wealth promised that they would share with me. And that promise has been retained. We get RMs to create their own business plans. There are no top-down targets given to RMs, so they're their own bosses. They get to decide how many account managers they want to have. There are no geographical restrictions. They can travel to any part of the country, any part of the world, acquire customers, incur costs. Those costs will get deducted from the revenue, and there's the net revenue share. So they are like entrepreneurs. And this, along with the fact that we've also made sure that everybody in the system is an RM first. So the team leader for an RM is also an RM first. Our city heads, unit heads are also RMs first. Our deputy CEO is an RM first. Our CEOs also manage clients. We have our product heads, mutual fund research heads, our structured product head. Everybody manages clients. Now, what this means is that their understanding and ability to empathize with the role of an RM, ability to empathize with the client key, where does their role fit into the entire client journey, and how they can make a wow experience or a bad experience from the client from the effort that they're individually putting in. There's a whole thought process that is inculcated, and I think it also brings a lot of agility in the system, that nobody here in the management team is doing theoretical management. Everyone is out in the marketplace managing real customers, real life situations, and therefore the ability to respond and have a pulse of the market is something that I think is a good edge to have. The other, of course, is over the last 7-8 years, this big process of saying, how do we sort of build an internal cadre? And which is what I mentioned, that we're hiring from top business schools. All account managers are mapped to RMs one-on-one. And these are the people who will go on to become RMs for us. So today we have 233 RMs and 228 account managers, most of whom we hope over the next 2-3 years graduate to become RMs. And in the last 3.5 years, 58 account managers have progressed to into the role of the RM. So this has been a very, very satisfying part of the whole journey. In fact, our regret attrition rates are amongst the lowest in the industry. And we won multiple awards. We've been consistently rated in the great places to work in a business where typically attrition rates are very high, and most RMs don't stick onto platforms for very, very long. So this is really on the productivity metrics, and this sort of a very important slide to give you a sense of what are the growth drivers and how sort of growth pans out in this business. Right, and the reason to actually sort of spend time here is there aren't too many wealth management listed businesses, and I thought this is the way how we look at the business, that it really takes at least 3 years for an RM to become profitable, and by year 5 is when they're truly profitable for us as a platform. So this table here gives you a mix of our current 233 RMs, how they're broken up between 0 to 1 year, 1 to 2 years, 2 to 3 years, 3 to 5, and more than 5 years. This is the count of RMs in the blue. The bar charts shows their contribution to the overall revenue. So if you can see RMs, 86 RMs who have spent at least 5 years in the system contribute nearly 70% of revenue. 68 RMs who spent between 3 and 5 years have contribute 21%. The balance contribute 3-5%. It's only when they go down this journey, when the 2-year RM becomes a 3-year RM, 3-year vintage RM becomes a 5-year vintage RM, is when productivity comes in. Today, 90% of our revenue is contributed by 87-90% of our AUM revenue is contributed by RMs with more than 3 years vintage. And what we want to do is ensure that RMs who are successful in the platform are covering their cost, are tracking long-term averages, are the people you want to ensure stay, because as these buckets move, they are going to drive the next year of in terms of next few years of kicker in terms of growth in AUM and revenues. And this is effectively the core of the business. And this is how we model the business. And therefore, the effort to ensure that every year we are adding 40, 50, account managers, which will in turn, go on to become RMs over a period of time. The other thing that we've also seen is that, what we were very successful with in the private wealth business was creating a very standardized process. And we said, how do we take this process, which is working so well with large customers, to the mass affluent? So today our customer segment is that 5 to 50 crore. But a similar solution could also be delivered in pretty much, in the same format to customers with 20, 30, 40, 50 lakhs or few crores of monies. But the challenge there was, how do you build a cost structure that allows you to deliver this, without having, because with the whole sort of multiple offices, RMs, the cost structures don't allow you to go to these customers in a profitable fashion. This segment is largely dominated by banks. And what we did was build a complete digital offering here with a human acquisition channel. So we partner here with IFAs who we call client engagement partners. These IFAs take our app, it's an iPad app, or they can take the computers to prospective clients, where they walk these clients through our app. And the app is sort of self-explanatory. There are videos, tools, etc., which clients walk through. And the end customers can sign up. And the entire platform, from the marketing, coaching, portfolio construction, advisory, ongoing transactions, ongoing handholding, is completely automated. There is no role of anybody else in the system apart from the platform itself. And we've seen very encouraging results. If you see today, the platform has about 737 crores of assets with 195 partners and about 3,500 clients. So we have about an average client size of 20 lakh rupees in this. Now, there are a lot of robo-advisors out in the market who are trying to solve a similar solution, but they're actually going to retail where the average ticket size is 8,000 rupees or 10,000 rupees. I think this is the first demonstration that, digital solution, end-to-end digital solution is finding traction in a mass affluent segment. And a lot of these technologies now on the reverse side, where a lot of the domain knowledge came from the private wealth business here, a lot of these technology solutions are going back into the private wealth side. So today our RMs also have iPads in the private wealth side, where they can actually collect client balance sheets, enter the data, and the iPad, the app will throw up a sort of 100-slide customized presentation for every client in a matter of seconds. And the entire journey is again standardized backend with algorithms and technology. So this has been an interesting sort of journey. This business has already achieved break-even for us. The other business that we built, and this was an acqui-hire, where we acquired this company called Freedom Financial, which had a product called OFA, Omni Financial Advisor. It was a tech platform for IFAs, which helped IFAs do financial planning. We took that platform and pivoted and said, instead of trying to get financial planning done through IFAs, let's solve their biggest pain point. And we pivoted to providing them reporting, business dashboards, so client reporting, their own reporting, understanding their business, client engagement tools, online transactions. And in a matter of 5 years, this has become the number one tech platform for IFAs in the country. We've got about 5,000 IFAs who pay us software subscription fees. So this is a SaaS model. Here, the IFA does not transact on our code, a broker code. They have their own broker codes. What we do is just report and process. And these 5,000 IFAs have about 1.6 million customers of their own, whose data we are processing and reporting back to all these guys. Net, I think if you look at what's happened to the business in the last 3 years, our AUMs have grown at 22%, and this excludes OFA, of course, because OFA is not our AUM. It is the IFA's AUM. So this is PWM and the digital wealth business, the private wealth and the digital wealth business. And this is a business which we believe, where our revenues are also linked to AUMs effectively, because our percentage income that we make is a function of where the market value of the underlying product is. And as market values, over cycles grow, our income should also grow. So I think this is the biggest driver for us from a long-term revenue perspective. And you can see we've also got a fair mix of, equity assets and equity-linked assets, which are our MLDs, 15% debt mutual funds, and about 10-11% in other products, which are stocks, PMSs and others that the clients might hold. Clients typically, as they come into the system, they will have products which we don't recommend, but they might still own. They'll transfer it to our DP. And, we'll sort of, over a period of time, try and transition it to our recommended portfolios. The other thing I think to note here is that, we're one of the largest guys are probably the largest non-bank, non-aggregator B2C distribution firms. If you look at in the form of commissions, we are just behind NJ and Prudent. And NJ and Prudent both are predominantly aggregator models. More importantly, if you look at our yield on assets, given this customer segment, clients really have long-term monies. They're invested for the long term, are willing to pay full price for those advice. Our yields also are 0.89% on mutual funds, which puts us at number 4 in the industry. And I think one of the powerful sort of demonstration of our relationship with customers and ability to advise customers is really the data point on the right, where if you saw last year when the markets fell, was probably the best time to get into markets. The industry as a whole saw about 39,000 crores of outflow in equity mutual funds. We are one of the few wealth management firms who actually saw a net inflow of 1.25 billion rupees here. So that's been satisfying that we've been able to sort of handle clients in this journey. From a financials perspective, we have reported 5-month numbers for this year, audit numbers, which are at 168 crores of revenue, a PAT of 51 crores. Our ROE has been consistently high with about 28% weighted average ROE. 21 was a sort of aberration year because in the market you will have cycles. Last year there were 2 impacts that happened. One, of course, markets fell, which meant some of our incomes dropped because our incomes are linked to the market value of mutual funds, etc. So that, of course, dropped. On the debt side as well, people went from the long end of the curve or from credit funds to overnight and liquid funds, which meant the commissions there also dropped. And also, of course, what we found was it took several months for clients to sort of start engaging digitally and transacting digitally. So combination that led to a drop. But I think what happens is we've seen that every 5, 7, 8 years, you will see some similar cycle, markets, impact. But across the cycle, there's a catch up. And I think if you see this year is effectively a catch up year, we've already achieved 60% of last year's revenue in the first 5 months and 113% of the PAT in the first 5 months. And also we've declared a dividend, which was last year, which was 30%, 31% sort of payout. So with this, I'd like to conclude the presentation and hand over to Lal.
Thank you for taking us through the presentation. We hope the attendees have captured enough and more understanding of Anand Rathi Wealth's business model, financials, and its execution capabilities. Before the floor is open for participants to ask their questions, I would like to reiterate to type your name and organization details in the Q&A chat box for the moderator to take note and address your query. Note, in the interest of time, we will be restricting to 15 questions only, and repetitive questions will be skipped. So there's a question which asks that what is the average size of your client?
The average size as of August was about 4.5 crores per client family.
Okay.
We define these clients as families. So we have 6,500 families. Each family might have more members under them.
Moving to the next question. Why is the net cash from operations in a minus figure at 21 crores for FY21?
Jugal, you want to take that?
Yeah, in FY21, largely if you'll see, we from the business, there was a cash generation of 83 crore rupees. So operationally, we have generated a cash of 83 crore rupees. But when we compare with the previous year, what we have seen is there was a significant drop in the current liabilities on account of 2 accounting head. One, the advances from customer has come down by about 88 crore rupees, as well as since the year it was a depressed revenue and incentive linked to the revenue was also down, where the incentives, provision for incentive was down by about 20 crore rupees. So that is why what we have seen, the cash flow at the net level, it was down by 21 crore rupees.
Thank you, sir. Moving to the next question, which asks that your 280 crore revenue for FY 2021, is there any institutional AUM included in this?
So as a matter of policy, we have no institutional AUM, we have no corporate treasuries, we have no promoter holdings counted AUM. In fact, we don't even, that's a corporate treasuries was the core business when we started out in 2002, but we sort of exited that business pretty much in the late 2000s. So our focus exclusively right now is on customers who have long-term money. So there is no, large corporate. This is all individual or individual owned entity money, which is long term in nature.
Okay. Moving to the next question. Your EBITDA percentage has jumped to 44.81% for the period ending August 2021. Can you explain how has this gone up?
Yeah, Amit, you want to share?
You can go ahead.
Yes.
So I think I can. Yeah. So effectively, what happens is that our business has high operating leverage, and as revenues go up, the operating leverage kicks in, right? Because also, 2-3 things have happened. One, of course, operating leverage. So if you see growth in the business, you will see margins go up. Second, also there was an impact where I think if you see FY21, there was a fair amount of cost rationalization also that happened through the year. We were able to save a lot on real estate costs, which have sort of almost become permanent in nature the way we operate. A lot of our other operating costs, including travel, etc., have gone down, which we also believe a lot of this is structural in nature, which will stay in place. So our belief is that this operating margin, as the business matures and as RM productivity sort of, as the mix of RMs start to become more in favor of older vintage RMs, your operating and EBITDA margins will tend to move higher. But I think that 40 to 45% is a good number for us to aspire to even in the long run.
Thank you. So moving to the next question, which asks, how are you planning to build a moat around your business, given that there are multiple technology platforms and digital players getting into this business?
So I think the biggest challenge in this business or barrier to entry in this business is trust. And I think trust, maybe there's a threshold at which trust has to matter. Maybe for a 5,000 rupee, 10,000 rupee customer who didn't have any advice, for them, it's very easy to move to convenient digital platforms. But globally, we've seen this when it comes to high net worth individuals, even for ourselves, even when we walk into a new relationship, let's say a customer has a 10 crore portfolio. Even if they love our presentation, they will not start with more than 50 lakhs, 1 crore, 2 crores. It's only over a period of time as that trust grows that we will end up having 5 crores, 6 crores, 8 crores out of, or maybe even 10 crores out of that financial assets that they own. So there's a journey there of trust which cannot be replaced by tech. Not saying that tech is not important. Tech is very, very important from a client experience perspective, and something that we've invested very aggressively in the last 5 years, as you've seen in our 2 fintech businesses. And all that tech is now coming through in the private wealth business. So from a tech perspective, we are there. But I think the biggest thing that customers want in this business is trust and credibility. And that's one of the reasons also that we believe that this effort to sort of this need to go public essentially will hopefully create more credibility in prospective clients as we continue to expand our franchise.
Would Rakesh like to add anything more? Rakesh?
I think that Amit has very, very aptly answered it. And I believe that every bit of product and strategy improvement that we are doing is a moat in itself, right? And I think that if we continue to create value, for example, the efficient frontier and various other concepts, we continue to stay ahead of the pack, so to say. So there's a 2-engine mode that's being created. One is on the value proposition, which is continuously improving. And the second is the trust element, which with time is continuously becoming better and much more with time. So my own sense is that it sounds easy, but very, very difficult to replicate.
I think fantastic point, Rakesh. Sorry, just add one more nuance to that. I think the trust factor, not just with clients, I think Rakesh and team have built a fantastic trust moat with RMs as well, where successful RMs do not want to leave. And I think that's the starting point, where if RMs are stick around in the system for 5 years, 10 years, 15 years, that's the biggest moat that you build in the business.
Absolutely.
Thank you. So moving to the next question. Your AUM has grown 22% in the last 3 years. You give better yield than the current listed AMCs and wealth management companies. Question is on the continuity. How do we see the continuity of this?
Firoj, please.
Yeah, sure. So the yields are high because of the first decision taken way back in 2007. One of the first few decisions of the segmentation. So since we are a wealth management outfit which goes to a segment which is not going to 100 crore, 200 crore client, but the 5 to 50 crore averaging at 10, 15, 20, this is a segment which is willing to pay if the value proposition is dovetailed to the requirement. That's point one. Point two, the yields are a function of how the assets are placed. Since our niche is carved out of that space of clientele which is looking for consistent returns rather than very high returns, 10 to 13, 14%, equity becomes a reasonable portion of it. So if you look at our mutual fund assets, close to 65% of the mutual fund assets are in equity mutual fund. So the yields are higher because of the asset allocation. Like Amit mentioned, there is not too much liquid money, corporate money, so that's why the yields are higher. Asset allocation and the product selection will decide the yield. Thirdly, as you become larger in the distribution fraternity, since we are in the top three mutual fund distributors on the basis of gross commission, the economies of scale increase your bargaining power, giving you that lift of 10, 15 bits. Now coming to the second part of the question, how sustainable is this? Because these three sources are sustainable, the yields are sustainable. When it comes to regulatory change on expense of mutual funds, for example, that I think, and we all believe, that has swung to the other side of the pendulum, making it very, very competitive when you compare with even emerged global markets. So there's largely no headroom for further squeezing of TERs on the mutual fund, is our belief, at least for the next few years.
I think there's one more angle to this question, Feroz, on the growth drivers for the 22% AUM. How is that going to sustain?
Okay. So then if you come to the revenue growth variables, there are four growth engines which we look at very seriously. And that's what sums up to our growth aspirations. And that's what has propelled in the past as well. First one is how we've positioned our clients' monies at 12, 10, 12, 14%. So if you look at 10% growth just out of the returns coming off clients' portfolio, that increases my AUM and in turn the revenue. That's one engine of growth. The second engine of growth is the idle capacity of our existing 233 relationship managers. The 233 relationship manager army is individually capable of managing 50 clients to 60 clients also in the post-COVID world. So current capacity utilization of the current machinery of the 233 RMs is close to about 50 to 60% because 28 clients per RM is what we are at. So as the idle capacity gets fulfilled by client acquisition, that's the second leg of growth. Just to illustrate, the last year was the best acquisition year for us in spite of COVID because client experience is resulting in client references, their friends being referred. So that's the second leg of growth, existing capacity being utilized. The third leg of growth is that 33% of our AUM comes from clients who are less than 5 crores. It doesn't imply that these clients have less than 5 crores. They have less than 5 crores with us today because they've begun. As the relationship becomes stronger and the umbilical cord becomes stronger and stronger, you penetrate into those relationships because the existing balance sheet itself is 10, 15 crores. So that's the third leg of growth, which is penetration. And the last leg of growth, which is new RMs. New RMs, which is the army of, or the nursery of plants which we have planted in the last few years, which grow to become trees. That's the new RMs creating new business opportunity and managing fresh AUMs and acquiring new clients is the fourth leg of growth. That's why our firm believes that all this put together, good quality, robust growth from these for long number of years is very, very likely.
So another way of putting this, for us would be that if the yields would not grow at about 20-25% over cycles, you'd be disappointed. Right? That's the attempt.
Thank you, sir. Moving to the next question, which pertains on yields itself. Mentioning that, can you see clients moving to an advisor model and hence impacting your yields, as in the case of IFM?
Okay.
Or Feroz can take that.
Feroz, you can.
Yes. So I think the advisory model has been into existence from somewhere around 2013. So it's about 8-9 years since this model has been there. In fact, last year there were some changes in what an advisory role could entail and what you can give to your clients. So several of them have actually surrendered their advisory licenses in our competitive landscape. Point one. So to answer your pointed question, no. Because most of these clients very well are aware of going the direct way and going the advisory fee model. But I think since our top 3-4 wealth managers who are our companions in the industry have surrendered their advisory license in October last year, as you would have read, we think that we didn't have to go down the path and retract like most of the large players have been.
And I can add to that also. I think it's important to understand that that our average client segment. I think IFL reports an average client which is much higher in a different client segment, which might be more cost sensitive, at least for us. And our client segment is today largely out of the major metros. A lot of professionals, first generation entrepreneurs who are digitally aware and are aware of direct plans, etc., but still choose to be on a full service, full priced model is because they see value in what we're delivering. So I think the choice of the client segment and the proposition that delivering them, this has withstood, the test of time over the last 5-7 years, where a lot of the market has been pricing. I've tried to build AUMs on the basis of discounted fee models, but our AUMs have continued to grow, our client acquisitions have continued to grow. So we're not seeing a challenge. I think it's really the focus. Maybe if you were to go to the UHNI space, maybe that would be a different paradigm, but we're not interested in going there at this moment.
Okay, so moving to the next question, saying, how do your yields compare between structured products, which is MF distribution, and you derive 60% of your revenue from the sale of structured products. So could you please throw some light on what these are?
Amit?
Yeah. So structured products are essentially nothing but market-linked debentures, or effectively globally, if you look at wealth management as a business, market-linked note or ELNs are the mainstay of the private banking industry. And what you do is these are essentially NCDs which have a payoff that is linked to certain underlying instrument in the market. So essentially a combination of debt plus some options. The MLTs that we design for customers have essentially plain vanilla long-dated options that are built into the portfolio. But the idea is to create some degree of uncorrelated returns for clients that help them improve the risk reward of the overall portfolio. And that's done actually very well over the last 8-10 years. And I think, globally, this is something that has always been there in India. Increasingly, more and more people will have to turn to, in our view, towards looking at creating uncorrelated returns. And MLDs are a great way of doing that. From a yield perspective, today, our mutual fund yields are about 90 basis points, and what we make on MLD is about 2.3%. Now, most wealth management firms would, typically have some degree of capital manufacturing. So if you were, we would have a PMS, which we don't do, or an AIF. And if you include the manufacturing fee, one would make a 2.5% yield on that asset. So it's a similar sort of yield, right? And because we only do 2 products, the ratio will be 50, 60, 70. That's the range in which it will move. But our aspiration is, and as we continue to grow our AUMs, our target is that we hope that, in the near future, we get to a point where it becomes more 50-50 in nature. And already we've seen in the first 5 months that our mutual fund revenues have gone from about 31% of revenue to about 38% of revenues. So directionally, that's where it's going. So I think the longer term direction for us is more towards 50-50 from a mixed perspective.
Thank you. So following question which asked that could you throw some more light on the revenue model of your market linked debentures as you just stated?
I think I just answered that question.
Okay, so moving on to the next question. How do we retain RMs? Have there been cases where any exits have led to client migrations?
Rakesh, sir. Rakesh.
Well, first and foremost, the regret attrition that we've had over the years has been in the range of 2 to 3%, right? And therefore has not been a major issue for us. Now, why has it been 2 to 3%? I think Amit stressed on the various people strategies and the culture that we've created in the organization, which has led to this outcome. So you've killed the whole thing in the bud by making sure that your attritions are very, very low. Yeah. Having said that, any RM which will move from anywhere to anywhere has an employability if he can move some clients. Yeah. And therefore, to expect that, hey, an RM will move from Citibank to Deutsche Bank or Anand Rathi to Deutsche Bank or Deutsche Bank to Anand Rathi. He will not move any clients is pie in the sky. However, the extent of movement has been very, very reasonable. Say about 30 to 40% has moved out and 50-60% has remained within the company. So from an overall perspective, any kind of risk fructifying into any damage to the business because of client movement has been negligible to nil.
Thank you. So moving to the next question, which asks, do you make any additional revenues in forming wills and trusts?
No,
I think
we don't.
we answered that.
Okay,
that we don't strategically charge any fee for wills and trusts, for the simple reason that if we have a family for which we have created a will or a trust, the kind of relationship build that happens because of that is phenomenal. And therefore, those clients stay with you for very, very long periods of time. And if you're making 1.2% yield from that client, the returns that you make on assets managed by you far, far, far outweigh the kind of transactional revenue that you might have made on wills and trusts.
Thank you, sir. Moving to the next question, asking that during the pandemic and the ensuing lockdown, how have you managed relationships and client issues, given that it's a very high-touch model? Could you also comment on the change in client behavior post-pandemic?
Firoj?
So, point one, post the pandemic, of course, like you mentioned, it's a high touch point business. In fact, if I have to put some color to that, our principle is to try and meet these 6,500 clients on a monthly basis. Because reinforcement and keeping people on the path by spending that 15 minutes to a half-hour review every month is critical. So post-COVID, 60 to 70% of our meetings at least have remained digital, which improves the efficiency of the army going to clients, point two. Point three, I think the adaptation of technology, given the age of our clients ranging between 50 to 60 to 65, they're far more adaptive to logging into a Zoom, looking at digital statements than printouts, which they would insist in the past. So this has created a huge opportunity for us, cutting through geographical restriction. Fourth point is that our research team, which is a 55 member team, today has the flexibility to accompany the front end team, and close to 1,800 meetings are being done by these people, which are research people, delivering better conviction in the marketplace. And that's where you see a fillip in the first 5 months. And that should continue in the post-COVID world.
Thank you. Moving to the next question. The decrease in ROEs, is it attributable to the change in the product mix over a period of time?
I think, if you look at the ROEs, just last year's number, which got impacted in some sense because profitability was impacted last year. But if you look at the first 5 months, I think we are back to a long run trend.
Thank you, sir. Moving to the next question, saying that you rely on nurturing the account managers to become RMs, which takes over 3 years. Your entire business is based on trust, which takes its own sweet time to develop, even if you acquire new customers quickly. From a business growth perspective, how do you plan to scale up aggressively?
I think
Amit?
sorry, go ahead.
Yeah.
So our idea is not to scale this business aggressively. This is a business. We are very happy with a 25% long-term growth rate. I think that very few businesses are able to do that. And I think what we don't want to do is risk the fundamental long-term growth rate trajectory in trying to build aggressively. I think we're able to do 25-30%. We're extremely happy because we can do 25-30%, generating a lot of free cash flow with a 30% ROE plus ROE, it's a great business to be in. I mean, one can always aspire to grow at 50% and 100%, and over some cycles, maybe you might. But I think, yes, it is an RM by RM business, client by client business. What you want can only do is shorten the sales cycle by building, greater brand trust, which is the effort, and through this IPO. But I think that 25-30% growth rate, we are very happy with that sort of long-term growth rate. We are not in that startup space where we want to grow 5x in 1 year. Unfortunately, this is not a business in the client segment that we believe that someone can, really do that. So it's a brick by brick business, but I think these metrics, are something that are exciting enough for us if we can manage to sort of continue down this path.
Would Rakesh, would you like to add also, how the growth is going to come of the, people also?
Well, I think that, Amit has touched upon it. I think Feroz touched upon the growth drivers of the business in terms of AUM. So therefore, and of course, we've got the AMs being, promoted to RMs. So the fact is that if we are looking at 233 RMs becoming 500 RMs in 2 years, no, that's not our aspiration, which is correctly, amplified by Amit. However, if we are looking at 20-25% kind of growth, and our belief is that in this customer segment, there are no shortcuts. Yeah, trust for human beings takes its own time to build, and you have to allow it to build. And if you try and force fit this with the client, whatever little you have worked on with him will be thrown away. Because the client is very sensitive to pushing, and therefore you have to give him time. If you don't give him time, then he'll say, "Hey, whatever trust you've built, you'll lose it all." So it's a business that you have to sort of build slowly and allow things to pan out in time.
Thank you. So moving ahead with the next question, which asks pertaining to the market-like debentures, what is the kind of risks involved for both Anand Rathi and clients? Secondly, how is your revenue flow for your MLD products? And what is the revenue share agreement between Anand Rathi Wealth and Anand Rathi Global Finance?
Amit?
Yeah. So I think, 2 parts. One is the last part between Anand Rathi Global Finance and Anand Rathi Wealth. There's an arm's length transfer pricing, which is equivalent to other pricing that you would get from issuers in the marketplace. There are other issuers as well in the marketplace, and that pricing is similar or better. So the pricing is at arm's length. Both entities negotiate and do the arm's length pricing. I think as far as the risk is concerned from a client perspective, the way the product is designed is important. Currently, the way we design products, essentially they are not fully capital protected notes, because then they become suboptimal for the clients in a lot of cases. But what we do is design products which give clients capital protection up to a 20% drop in the markets over a 3-year period. Now, why have we chosen a 20% drop in the markets over 3 years? Because over the last 20-21 years since the F&O market has been active, the worst 3-year drop in the market has been about 19%. Now, of course, it could drop greater, but we've designed a product that under most circumstances, clients should not lose money and should outperform the markets up to a 13-14% per annum rise in the markets. Products are designed to sort of outperform long-only products. So the idea is to create, again, uncorrelated returns for customers. As far as Anand Rathi Wealth is concerned, there is no risk except that you're distributing a product. There's no balance sheet risk. Anand Rathi Global Finance, which is the issuer or any other issue that we were to source from, they have to hedge this option risk. And the current products that we design or we've been doing for over a long period of time actually have fairly vanilla options within them. So the issuer would actually have to either delta hedge those products or find other counterparties, which, there are a lot of counterparties in the market which you can actually go find, or run a hedging book till you find those counterparties to hedge away the optionality in that product.
Would Feroz like to add the performance of the MLDs in last few years, so that I think that will explain the risk of the customers. Feroz?
Yeah, sure. So from a history of MLDs in India, if I have to just spend about 10 seconds there, 2006 July was when the first issuance happened. I think it was Merrill as an issuer. So it's been about a 15-year-old industry in India. Globally, it's one of the most sold and bought product. From 2012, ARGFL has been issuing. We have also been sourcing from other issuers, currently about 2 of them, including ARGFL. So there are close to about 759 products, individual issuances which have matured from 2012 till now, out of which close to 89% of them have given the maximum possible expected return of the product. 95 to 96% of the 760 have delivered at least a 6% return and upwards, which is opportunity cost, if we simplify it. And all the products have given at least their capital back, even the ones which incidentally matured during the peak of the pandemic of March and April. Resultant outcome of this positive experience, which the client has, 78% of our last 3 years MLD's gross sourcing is from people who are buying it as a repeat purchaser. So that's the kind of predictable outcomes the MLD brings. It does not give a huge windfall gain like mutual funds can probably in a year like this year or last year to this year could give 50, 70, 80% return as well in a year's time. But an MLD gives you capped return with higher probabilities is what that stands for to bring down the risks of the portfolio in combination with other 2 constituents of mutual funds and debt mutual funds.
Good. Yeah.
Thank you. Moving to the next question. Could you give us an indication on what is the price and multiple at which you acquired Religare Wealth?
Yeah, who would like to answer?
So I don't know if it's there in the RHP, but essentially, it was a distress sale. So really, let me put it, the value was insignificant.
Okay, sir. Moving to the next question, which indicates that if we were to take your FY21 revenue of 279 crores and divided by the AUM of 1,11,000 crores, we get a revenue yield of 25 basis points. This is much lower than the yields you mentioned you make in distribution of mutual funds and structured products. Could you throw some light on this?
Where is this figure? 1,11,000 crores.
I think there's some wrong calculation there.
I think the figure of 11,000 crores, 1,11,000 is incorrect now. Last year it was about 25,000. What is the AUM last
year? And our AUM was 26,670 crore rupees. Yeah. And typically the AUM, because that is year-end number, so weighted average AUM could be in the range of 25,000 crore rupees. And the revenue is compared with that weighted average AUM.
Thank you for the clarification, sir. We'll go to the next question, which asks that do you have any plans to go abroad for your clients?
So we have, a lot of customers, NR customers who do transact with us from across geographies, and we have a representative office in Dubai, which caters to a lot of NRI customers, and we have a lot of NRI customers from around the world, essentially, who will transact with us. But we haven't looked at geography. I think the opportunity, we will look at it selectively, but I think the opportunity within India as well, we're still scratching the surface, is our belief. There is so much opportunity, not just in still remaining in major metros, but even beyond major metros. If you're seeing the kind of wealth creation that's happening in tier 2, tier 3, tier 4 cities, and the penetration of advice within that wealth, there is a massive opportunity to sort of just put our heads down and just focus even within India in the next 10 years rather than trying to do. I mean, that's our belief, right or wrong. I think there's a whole lot of stuff to do within India at this point.
Okay, sir. Moving to the next question, which asks that there are quite a few related party transactions disclosed in the RHP. Will this continue post listing?
You will.
No, these related party transactions have significantly come down, and now more or less it has come to zero. Earlier, there was some inefficiencies in receipt of advances from clients against purchase of MLDs and the actually issuance of MLDs, because the trustees and the creation of IGINs used to take 1 to 3 days time, and we used to end up having these advances in our balance sheet, which were lent to the group entities for 1 or 2 days time. So since now that inefficiencies have been addressed and the MLDs are getting purchased and credited on the next day itself, so the company is not left with any such surpluses to be deployed for ICDs.
Just to add to that, I think basically these transactions represent surplus funds available with one entity and being given to others at the market rates in order not to lose the advantage of interest. Now that practice, since we are getting, this year we have stopped that practice now, and therefore there is no likelihood to be, lot of interrelated party transactions.
Thank you, sir. Moving to the next question, which states that given that there is high competition coming in from these digital platforms and free advisory services, do you see any kind of impact on your net margins, coming in the near term or in the future?
I think I've addressed this to some extent before, where I believe a lot of these direct platforms are either targeting, at least the tech platforms are targeting the retail end or the top end of retail, which really had access to no advice at this point of time in any case. And it's really targeting to some extent the IFA community base. That is why. So the industry, they're expanding the industry, getting a lot of new people in. And the direct model is also popular with the super ultra high net worth individuals, people who have 500 crores, 1,000 crores, for whom cost considerations at that scale become important. And really for us, we've not seen this. Direct plans, like Firoz said, have been around for 7, 8 years. A lot of the tech platforms are around for 3, 4, 5 years. And, Amphi itself has been advertising direct plans, as a lot of us have witnessed, on media. But our customer base continues to, customers who believe they need advice and handholding will continue to pay for advice, because I think it's, can you justify the value created? And I think today we're able to do that, and it's reflected in our customer additions and AUM growth that we're seeing.
Thank you, sir. Moving to the next question, which states, how do you compare yourself with the universal bank-run wealth management businesses?
So I think it's, one of the realizations that is, and we can talk from our own experience, right? I think when we started this journey, we tried to think of this like a universal banking situation where we said, can we do insurance for customers? Can we do currency hedging? Can we do X, Y, Z investment banking? Trying to do 20 different things from customers and saying, let's get as many hooks. And we realized that, it's a very difficult, you have to be best at what you do in everything that you deliver to the customer. And we've learned the hard way that, look, the whole concept of universal banking itself globally is collapsing, right? And, you saw models like Citigroup, etc., which all trying to build universal banks and now starting to disaggregate. So I think the time has come where the world itself, financial services world itself, is again disaggregating to saying, let's stick to niche markets where we can deliver exceptionally well a certain service or product. And that's what we're seeing. So universal banks have an advantage where the customer acquisition is there. But this whole concept of being able to cross-sell is an oasis in many ways, where, it's a mirage in many ways, where a lot of people have struggled to actually saying, I have a customer base and I'll be able to sell 5 products just because I have the products. The point is, are you really exceptionally good at that product and the customer buy from you? Because today customers want the best product or service in whatever they're buying, and not just because of the relationship. So I think, honestly, and a lot of our customers today who we're acquiring are actually coming from these banks. Our marginal customer that's coming, a lot of customers actually coming from these banking institutions. So we're honestly, I don't think that's, we're not seeing that as a path forward for us or a competitive threat. We really have to be good at what we are doing, and that's what we're focused on.
Anything Rakesh or Firoz would like to add to that?
So one thing I can add, let me wait for Rakesh sir to add something, and then I'll probably take my...
I might, as Amit said, that I don't see any correlation between having a bank account or doing some FX transactions and private wealth, right? And therefore, if you give good quality private wealth, a person says, hey, I will only do it with you if you have a bank account, is not what stand out in the marketplace in terms of customer response. And therefore, I agree with Amit that we have to have, specialized verticals to lead to, which will cater to specialized demands of people. And that's what so far has been our experience. From a small value to 30,000 crores is evidence of that. Rose wanted to say something.
Yeah, I think from a banking standpoint, if you look at how a mutual fund distribution, which is a long-term trail generating revenue business, how have banks fared over the last 10 years, you would see that the charts have changed, turned over its head. So transactional business has resulted in a lot of market share going away from long-term business like a mutual fund. If you see the league tables of 2011 and 21, you will get a sense. So I think banks are losing some share to wealth management outfits.
Thank you. Moving to the next question, which asks that do you have any new product in the making that will be augmenting the growth, for the company in the coming times?
So, Rathi?
I'm good. I think, look, I don't take that. So I think, look, we have a 55-member product team that is constantly looking at product ideas, evaluating product ideas across the spectrum. And there's constant, but I think we're also very, very selective that we will not take a product to market unless it fits various filters that we've set in place. Because, there is a traditional tendency, or there's a typical tendency in the market, and we've been guilty of that for many, many years before we pivoted our model of doing everything under the sun, from pre-IPO funds, to real estate products, to, a lot of alternatives, to private equity funds, to structured, sort of mezzanine funding, angel financing. We've done all of that. We've been through that journey. But we realized, that's a good way to attract customers, but not necessarily in the customer's interest, or are we trying to solve a problem? Because what we've come down to today is saying, if our customer needs 12%, 13%, 14%, let's find the simplest way of getting that customer there. And if you can get the customer there and the customer believes you can get him or her there, they're willing to stay with you and pay you your fee. So our approach is, yes, we're looking at all sorts of product in the market. We have a very large, one of the largest product teams in the market, constantly evaluating. But our threshold of a product going from research into the mainstream, into clients, is very, very high. So never say no. But at this point, we are sticking with what we're doing.
Thank you, sir. There's a question which asks that do we market any third-party PMs or AIF products?
Again, I just mentioned, and I think Feroz can add to that, it's just that we haven't found product categories that have increased the risk return or improved the risk return profile for customers from what we're doing currently. But Feroz, you can probably elaborate on.
So we are evaluating both PMS and AIF on a continuous basis. Of course, those are evolving platforms, and currently we've not approved any of them because we have 6 layers of filter a product needs to pass before it comes to mainstream and form part of client portfolios, because product failures are one of the largest reasons why client attrition happens. So you have to be very careful there. So 6 layers of filter they have to pass. But are we examining a couple of AIFs and PMS? The answer is yes. But have they seen the light at the end of the tunnel from a recommendation standpoint? The answer is no.
Thank you, sir. Moving to the next question. Given the NSCIL event, how many of the clients that were retained out of the ones which were negatively affected, and what was the success rate for capital protection bonds in terms of capital gains? Did the clients make money beyond risk-free rates?
So I think the second part of the question, Feroz already answered, that of all the issuances on structured MLTs that have happened, almost 90% have given the peak return, and 94-95% have given 6% or higher. So that, I think that part is already answered. On the NSCL case, now that's a 2013 matter. It's 8-year-olds. There were close to about 100 odd customers who were impacted. Majority of the customers are still on the platform and continue to work with us. And I think the effort right now is really to focus on, for whatever customers are still stuck, capital money is still stuck, to sort of work with the agency to ensure that the money is recovered quickly.
Thank you, sir. We'll end with one last question, which can be attributed to the bankers, is that, the market leader IFL Wealth is valued at a 35 PE, while you are valued at a 46 PE. Please advise on the justification of this.
Yeah, so I can take that, and again my colleagues can add. So if you look at the annualized number for profit for FY22, this looks at a PE of around 18 to 18.7 compared to IFL Wealth at around 25 to 25.5x FY22. So clearly this is at a discount and not at a premium. That's one point. The second is, if you look at the profit growth for 5 months of around, so it's really significant. We have already crossed the FY21 profit number that was achieved. And third aspect, what I would like to highlight is the valuation is clearly based on the feedback that we have got from institutional investors, post detailed investor roadshows as well. And we strongly believe that given it's an asset light model with an average ROE of 30% plus, the valuation number is justified number. Happy to take inputs from my colleague banks.
You would like to come in? And you want Samir, any Vishal or some banker to?
I think Samir has covered pretty much what is the fact, in the sense that it's actually at a discount to the probably the only peer in the market. And I think the performance, the 5-month performance kind of bears out what we look at. If you're looking at multiples based on the trailing 12 months, I think given what happened last year, I think it's not correct to be compared.
Thank you, sir. We'll end the Q&A session with this. Thank you, everyone, for showing interest in knowing more about the company and its leadership and future potential. I would now like to call upon Mr. Vishal Bangar from IFL Securities to make the closing speech before we end today's webinar.
Yeah, but before that, 1 minute, Lalit, I'll take. I must really compliment the people. I think very, very good, intelligent questions have been raised. And I hope that, we have been able to give the satisfactory answers to all the questions which have been raised. Now, over to you, Vishal.
Thank you, Rathi ji. I'd like to thank you all for taking time out and attending the broker and analyst meet for the IPO of Anand Rathi Wealth Limited. Anand Rathi is one of the earliest professional wealth managers in the country, and they have a strong legacy of over 25 years of experience out here. Just a quick reminder of the details of the IPO. The price band for the IPO has been set at rupees 530 to 550 per share, with a discount of rupees 25 for eligible employees bidding in the employee reservation portion. At the top end of the band for the IPO, the total issue size is approximately 660 crores. 50% of the net issue is available for allocation to qualified institutional buyers, 15% for the HNI segment, and 35% for the retail segment. The issue will open for subscription on Thursday, 2nd of December, and close on Monday, 6th of December. The anchor round for the issue will open and close tomorrow, which is Wednesday, 1st of December. The issue is seeing strong support from large institutional investors. The anchor book will be available on the websites of both the exchanges on the evening of the 1st of December, that is tomorrow. We look forward to your support to make the IPO of Anand Rathi Wealth Limited a huge success. Thank you all once again for attending today.
Thank you, Mr. Bangar, esteemed audience. We've now come to the end of the webinar, and we look forward to your participation and support on making this initial public offering a great success. Wishing you all a great day and keep safe.
Great. Thanks to you, Lalit, for moderating it so well, anchoring it so well. And thanks to all the participants once again, and thanks to all our bankers and my colleagues. So we close this, right?
Yeah. Thank you.